studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
So far, we've learned that capital gains generally increase the capital dividend account and capital losses generally reduce it. This naturally leads to an important question. What happens if a corporation experiences more capital losses than capital gains? Can the CDA actually become negative? The answer is yes. More specifically, component 1 of the CDA calculation can become negative when the non-deductible portions of capital losses exceed the non-taxable portions of capital gains. Let's look at the example shown on this slide. Suppose a corporation realizes a capital loss of $50,000. For CDA purposes, only the non-deductible portion affects component 1. Since 50% of the loss is considered the non-deductible portion, the CDA adjustment is $25,000. As a result, component 1 moves from 0 to a negative balance of $25,000. At this point, many students immediately become concerned. They assume the corporation has created a tax problem. Some even assume the corporation may face penalties or additional taxes. But that's not what happens. And this is one of the most misunderstood rules in the entire CD regime. A negative component 1 balance does not create an immediate tax consequence. There is no penalty. There is no special tax. And there is no special filing requirement simply because the balance became negative. The negative amount simply carries forward into future years. Think of it like a deficit that sits on the books waiting to be offset by future non-taxable capital gains. In other words, the corporation is not punished for having a negative component 1 balance. The balance simply remains there until future transactions change it. The most important takeaway from this slide is this: a negative component 1 balance does not automatically create a tax problem. It simply represents excess capital losses that have reduced the CDA calculation. In the next slide, we'll look at the special CDA rule that surprises many tax preparers. You'll see that even when component 1 is negative, other CDA components can still generate available tax-free capital dividends. This slide covers one of the most important and most misunderstood concepts in the entire capital dividend account system. Many students assume that once component 1 becomes negative, the corporation can no longer pay any capital dividends. But that assumption is incorrect. In fact, the Income Tax Act contains a special rule that prevents a negative component 1 balance from affecting the corporation's other CDA components. Let's see how this works. On the left side of the slide, component 1 has a negative balance of $2,500. This negative balance exists because previous capital losses exceeded capital gains. At first glance, it may seem like the corporation has no CDA available. However, this is where the special rule becomes important. For purposes of calculating other CDA additions, the negative component 1 balance is effectively treated as 0. In other words, the negative balance does not contaminate the rest of the CDA. Think of the shield in the center of the slide as a protective barrier. The negative component 1 balance stays on one side. Meanwhile, other CDA generating transactions continue to function normally on the other side. For example, suppose the corporation receives a capital dividend of $1,000 from another corporation. Or perhaps it receives life insurance proceeds, or a trust allocates qualifying capital gains to the corporation. All of these additions can still create CDA, even though component 1 remains negative. Let's focus on the example shown here. Component 1 is negative $2,500. The corporation receives a capital dividend of $1,000. Because of the special rule, the $1,000 capital dividend is still added to the CDA calculation. As a result, the corporation has $1,000 of available CDA and may pay a $1,000 capital dividend to its shareholders. Notice what happened. The corporation was still able to pay a capital dividend even though component 1 remained negative. This is the key lesson. A negative component 1 balance does not eliminate the value of other CDA components. Capital dividends received, life insurance proceeds, and trust allocations can continue to create available CDA independently. A useful memory rule is this: negative component 1 does not contaminate the rest of the CD. Or said another way, a negative component 1 balance does not automatically mean capital dividends are impossible. In the next slide, we'll follow a complete timeline example and see how future capital gains gradually eliminate the negative balance and eventually restore component 1 to a positive position. Now let's bring everything together with a complete timeline example and see how a negative component 1 balance is eventually repaired. We'll follow the corporation through several years and watch how the CDA changes over time. Let's start in 2008. The corporation realizes a capital loss of $15,000. For CD purposes, only the non-deductible portion affects component 1. Since 50% of the loss is non-deductible, component 1 is reduced by $7,500. As a result, component 1 now has a negative balance of $7,500. At this point, the corporation has a deficit in component 1. Now let's move forward to 2011. The corporation realizes a capital gain of $10,000. The non-taxable portion of that gain is $5,000. This amount helps reduce the deficit. However, because the previous negative balance was larger than the gain, component 1 remains negative. The balance improves from negative $7,500 to negative $2,500. The deficit is smaller, but it has not been eliminated. Next, we move to 2014. The corporation receives a capital dividend of $1,000 from another corporation. This is where the special CDA rule comes into play. Even though component 1 is still negative $2,500, the corporation can still add the capital dividend to its CDA. As a result, $1,000 of CDA becomes available. The corporation could even pay a $1,000 capital dividend to its shareholders. Notice that component 1 remains negative, but other CDA components continue to work normally. Now let's move to 2019. The corporation realizes another capital gain, this time $20,000. The non-taxable portion is $10,000. But remember the rule. Future non-taxable capital gains must first eliminate the existing deficit. The first $2,500 removes the negative balance. Only the remaining amount creates positive CDA. After the adjustment, component 1 becomes positive $7,500. The deficit has been completely absorbed. The corporation is now back in a positive position. This timeline illustrates one of the most important concepts in the CDA system. A negative component 1 balance is not permanent. It simply carries forward until future non-taxable capital gains eliminated. And while that deficit exists, other CDA additions, such as capital dividends received, life insurance proceeds, and trust allocations can still generate available CDA. The key takeaway is simple. Future non-taxable capital gains must first eliminate the negative balance. Only after the deficit is fully absorbed can component 1 begin generating new positive CDA. Understanding this rule is essential because it demonstrates that the CDA is not just one running number. It is a collection of components that interact under special rules, and those rules can create valuable planning opportunities for corporations and their shareholders.